Welcome, everybody, to another edition of ATL Alts. This is your host, Andres Sandate, and I am joined once again by Brad Gunter, the founder and chief executive officer of High Point Advisory Group. How are you today, Brad?
Doing great. Ready to get back into another one.
Yeah, let's do part two. We finished part one talking about acquisition as alpha and how, as advisors and intermediaries to business owners, we could assist them in growing, if you will, their operating business, or putting in place a framework to acquire additional operating businesses, and how owners and their advisors can think about buying the business and the different disciplines that go into that. So again, go back and check out episode one. Today in episode two, we want to talk about the business and the operator to the institution, and what it looks like to actually operate and run the business at an institutional level. So I've got a lot of questions. We went back and forth and sort of framing these up, but really today it's about the forgotten chapter. I think so many times when we talk about M&A, we talk about acquiring and we talk about selling. We don't often talk about that middle road, that long road, sometimes a shorter road of operating a business. And so let's just jump right in. In episode one, we established that up to 75-80% of an owner's net worth is tied up in their business. Here's what strikes me: an RIA will be rebalancing a client's liquid portfolio like monthly, quarterly, more often, stressing it, reporting on it. And meanwhile, that's only a small portion of the client's overall net worth when you think about their operating business, which is generating cash and probably growing if it's a successful business. And it typically remains untouched and it just sits there in the background. And for RIAs, what we're saying is we want you to get much more integrated, much more involved in understanding what's going on in that business. So talk, Brad, about why the years between transactions, the purchase and the sale, the years in between are the most critical and most often overlooked stretch in an owner's financial life.
Yeah, no, great question. Great way to kind of start this thing. I think first of all, again, when we're talking to RIAs here, I don't think we're asking anybody to step in and actually run the client's business. What we're
Yeah.
asking is for you to kind of ask enough questions and be able to stay aware what it's doing. When this goes dark, that's when it's kind of the most dangerous. I'd say this is generally where 90% of the value is created or destroyed during those years. At the end of the day, everybody focuses on, kind of, as you mentioned, the acquisition or the exit. Those are just the pricing points. You've got to build the value in between those. And that's really where you create that multiple arbitrage. That's where you create those large liquidity events. You keep going from there. And again, like I said, there's 90% or so of the value is created in those years. A lot of times nobody's managing this at all. So you've got an owner whose head's down, it's kind of the one-man band pulling all the strings, and you don't have anybody stepping back saying, hey, what does adjusted EBITDA actually look like, and what kind of multiple can we get on these things, and under what circumstances can we expand EBITDA? We should be doing that on a monthly basis as we review financials. And under what circumstances can we get a higher multiple? It's a really simple equation when you come to sell your business. So, the big thing is I would say ask your clients, what's your plan to grow EBITDA over the next couple of years? And if they just kind of look at you, well, I'm going to make sure there's cash in the bank account, and I'm going to make sure we are avoiding a going concern, that's an issue, right? You want to know which levers they're pulling. You want to be able to have those intelligent conversations, because the math's kind of brutal in both directions, right? If it's flat, you're going to get a decent multiple for it. If it's growing 15% year over year, it's a whole different ball game. And especially if you can explain why and show that, hey, this is going to continue long after I'm gone, you can drastically improve your odds on the favorable exit.
Yeah, and that's a good thing, not only for the owner who's worked his or her lifetime, or in many cases, grown a company amidst all the challenges, right? We don't have to go into that, but it's also good for the advisor. And if you're listening as an advisor, hopefully you're taking what we're discussing here and saying, maybe this is an opportunity to go and sit with the clients and say, I want to be much more involved and integrated. Like Brad's saying, you're not running their business. You're not asking to step in and take over. What you're asking for is more insight, it sounds like, and more perspective. Let's define, when you talk about good operating infrastructure, Brad, what does that mean for a business? Let's take a typical RIA's customer who's doing, let's say 20, 30 million up to 100 million of revenue. What does that look like when you say good operating infrastructure versus just running a profitable company?
Great question. And there are a couple distinct things we look for. It's a lot of gray, right? So it's not necessarily black or white, but there are
Yeah.
some black and white items, right? One that I think 80% of you will laugh at is make sure you're on accrual accounting for your financials. We are looking at a couple new clients right now that are in the $60 million ballpark that are still on cash accounting. And while I may be the best or worst CFO in the world, I don't care who's looking at those numbers. It's hard to make heads or tails of them, let alone somebody who's just been in operations their entire life. All those guys are doing is looking at the bank account and saying, hey, we have cash, let's keep rolling, not looking at this from an adjusted EBITDA standpoint, pushing it forward. Governance is another thing we always want to click into. Is there a board? Is there somebody that you're reporting to? Are they meeting regularly to monitor KPIs and move forward? When it comes time to transact, if you can show, hey, here are the last 3 years board meetings with the notes and what we decided in each of them, and the same board is going to continue. Whether or not you would like to adjust it, or maybe you do want to adjust it, that's fine. But that builds a lot of credibility. The systems and data, a business should be able to answer questions without having to go to the controller and then having to go heads down for 2 or 3 weeks to get you an answer. Customer concentration, margins, unit economics. I mean, I can't tell you how many manufacturing companies that I work with that you walk in the door and they ballpark gross figures on basically their entire operation, but they can't tell you on each product line versus the ones that do. And pretty quickly they're going to get a premium when it comes to the closing table.
Yeah.
People, you want a management team, right? You want layers of management so that owner is replaceable. At the end of the day, a buyer really wants to buy a bond at the end of it, right? You want to buy something you can either bolt on or something that's going to be consistent and slowly increasing in value over time and paying you cash. So you really need to think about it from that way.
Yeah. I mean, I think what you're describing to me sounds like, if I'm an RIA, and at Gramercy, we're trying to do more of this, is we're sitting, when we're doing, let's say, a quarterly update with a client and going through just the market and giving an economic update, we're spending time in that hour, getting a 20-minute update on the business, right? And maybe that's going to take earning a little bit more trust and maybe some confidence and positioning your RIA and your role as an advisor, a trusted advisor to that CEO or that C-level executive, as, hey, we're not trying to be nosy here. What we're trying to do is hopefully put the RIA, put the advisor in a position where they're looking at us and saying, this is an individual that's obviously vested clearly in growing the multiple, helping me grow the business, and is asking much more operational questions than the advisor down the street, right? Who just wants to gather assets and just wants to invest my assets and move on to the next client.
Well, really quickly,
Yeah.
Andres, if you're kind of positioning yourself during that whole period as an interested party, you're a lot more sticky as an advisor than somebody that checks in quarterly or, God forbid, annually to look at the numbers there. As for the expertise, I think most of us here are pretty competent financial professionals, but the operational piece, that's exactly where we're here to step in. Our bread and butter are two things. It's really transaction advisory and helping manage those OpCos in the lower middle market to really juice them, make them profitable, and maximize that exit. That's exactly the gap we want to step into.
Yeah, and that's one of the reasons why we partnered with High Point Advisory Group and why we are bringing them into the Endurance X, platform. It's not that you guys offer investment services and you're not an investment advisor, you're not a competitor, you're not doing the wealth management piece. What you guys are doing is a really critical and important step in the role of serving our clients more holistically, right? You're able to sit and have this discussion around diagnosing what's missing, and then help the client, our mutual client, in many cases, sit and identify what's missing and then put a roadmap together. And that's what really episode 2, and we're going to talk about. And then obviously in 3 is when we get through that piece, is then preparing for exit, which will be our 3rd show. But let's talk about this diagnosis step, because we sit down with a CEO, they're running a $50 million revenue business. They've got, they've got all these different roles, right? They're coach, they're player, they're recruiter, they're the sales executive. You talked about that in episode 1. And yet there's some things that are falling short. And you're walking into these businesses, and we've seen that, right, before as well. But what is the pattern of what you see missing typically in these lower middle market, businesses?
Yeah, I would say it starts and ends with the cadence there, right? I think a lot of business owners will say, "I run a $50 million business." Okay, 50 million what? Are we talking cash revenue? Are we talking accrual based? Are we talking profit? And they just kind of stop and back up for a second. Well, hey, if you're running a 0.5% net income margin business on $100 million, yes, you're making money, but you could really expand those margins and do a little bit better.
Yeah.
What we see pretty consistently is finance treated as an afterthought. There's cash in the bank. We don't have anything to worry about. We're going to be fine. A more institutional way of looking at this is, hey, everything is inline GAAP accounting. We are putting together a monthly financial report. We're sitting down with, be it High Point, be it someone else, a fractional CFO or professional that knows this backwards and forwards, and they're giving us advice to grow the company, right? That, the companies where you see consistent 15, 20, 30% adjusted EBITDA increase year over year over year, that's not an accident. They're pulling strategic levers month after month after month and realizing the vision of their leader. And that's what a key finance professional does. Other kind of pretty easy ones, again, the owner dependency is pretty self-explanatory. A lot of times that's the issue, is the owner is the only one looking at the financials, and it's a very different skill set. Most business owners aren't also chief financial officers. They're not controllers. They may be bookkeepers, which means they just want to dive into the granular accounting details, which means they're just going to waste time, go heads down and say, yep, that looks accurate, not actually look at the bigger picture and work from there. A lot of times there's not a lot of separation between personal and business. I know we've all got clients that run lifestyle businesses. Love that while it's operational, but you're not really prepping for the exit, which is the single most important transaction you're ever going to have. And again, just that reliance on the bank account. I can't tell you how many times we see that where folks say, got enough to go on a couple vacations this year and we're going to be fine, rather than building that institutional transferable asset.
Yeah. I think the piece that really got me, sort of thinking about where we can translate and transfer, if you will, a playbook to the RIAs that are listening. Again, our platform is much more than just investments and looking at private market strategies, et cetera. What we're trying to do is give the advisors, hopefully the folks that are listening, toolkits, right? And resources and experts, like yourself, who can sit with them to serve their clients, right? And in this specific area of, maybe you have $100 million, $200, $300 million book of business, maybe you have a $50 million client, and, they've got a lot of liquid assets that they're giving you annually to deploy, but maybe they've got a really, really complicated set of assets that involve real estate, involve operating businesses, involve a whole bunch of other things. And I think that when you talk about things like IP and you talk about all this ownership and how it's arranged and the structure of it, is something, when we got to talking, Brad, that I thought was fascinating about how you guys start to lay all that out. And that was one of the reasons why Brian and I at GPWA were excited about building the relationship, and why I'm like, this can translate to other RIAs. There's no reason other RIAs should not have a Brad helping them, right? Because you're able to offer family office style services, family office style road mapping to clients that you can see have all these issues. And so walk us through, like, what does a clean structure look like? You talk about things like HoldCo and OpCo and real estate and IP and separating all of that to get the highest ROI for your owner clients. And I think, we are spot on, like totally aligned around that, knowing what you own. But when you pull the org chart apart and you sit down with the client, like, what is optimal when you have all those different boxes and buckets?
Yeah, no, great question. And I mean, the favorite consulting answer is going to be, it depends, right? It depends on your specific situation. You're also going to want your tax advisor structuring this. You're also going to want legal. But what I typically see is a lot of folks have an entity structure that they just happen to grow into, right? The reason they have an operating company is because it was established years ago. Then they bought some real estate and somebody told them to dump it into it. The IP is wait, it's probably commingled with the operating company. There are, it's kind of fewer. You need to think about it from two perspectives. One is tax efficiency, which I know a lot of RIAs on this call are going to be very well informed on. If not, there's some great tax professionals. I know, Andres, you've got a number in your network as well. There are, and essentially it's two questions: the tax efficiency, and then it's limiting liability, right? When one of these implodes, you don't want it to take out the whole ship, right? So even, within our advisory group, for example, we're going to have multiple entities to make sure, if something goes sideways on a transaction, then it's not taking out the recurring revenue. You want to separate all of these, right? So generic clean structure, you've got a HoldCo at the top, you've got operating entities that are running by themselves. You may have a shared service client, right? For instance, if you've got accounting or back office functions in one that are also going outside, great. You probably want to ring fence that. You want an IP company if there's some type of crown jewel, some patents, those types of assets that can stay off on themselves. That way you have some of the licensing rights and that type of thing set up. Again, it's going to depend specifically on that. And honestly, it's pretty high ROI work. Yes, nobody likes spending money on legal fees to get this done, but what it prevents, the kind of catastrophic meltdown, if one of these hits everything, you want to isolate those risks in a circle separately. So I would say definitely, we're happy to give you our take on it, but you definitely want to talk to your attorney on how to limit liability with those.
Yeah, I mean, one of the things that we talked about, and I borrowed this term that Brad shared with Brian and I in one of our strategy meetings, is flooding the zone, right? Like, you don't want to overwhelm the client with too much, but I think it can be a thoughtful exercise around sitting down with the client as an RIA, as an intermediary, as somebody that's traditionally maybe looked at their investments and their taxes and their retirement planning, maybe doing the 401k at their for their firm or for the firm. Stepping back and saying, have we looked at the ownership of the assets? And you've got some really great consulting frameworks and things you've built and some of your IP, which, I think we would both agree, sometimes just visually seeing stuff helps. And so for those listening, if those are of interest, definitely reach out to me, I can connect you with Brad, because I think as you sit down and you see how this, really hits with a C-level executive, with an owner, it just sometimes helps to have that fresh perspective. And I think it gives the RIA, the advisor, it gives you a really clean understanding about where are the different levers that you can make an impact. Let's talk about the framework. And well, before we do that, let's talk about one thing you brought up, and that's the people, right? Because I imagine an owner can buy a software, faster than they can replace themselves. It seems like with AI today, everybody's talking about, okay, what's the impact going to be? How much of this is about systems that these owners and CEOs have, and how much of the, I guess, decision making is about, the people in this new age we're in?
Yeah, I mean, it's just daily, right? But today, what I would say is systems are probably 30%. Those are the easy parts. Anybody can come in and say, hey, we're going to implement an ERP, or, here's a new reporting package. Those are systems that we kind of breach. It's it's really the people operating those systems, right? I know a lot of folks think with AI coming and everything else, great, it's going to take all professional services at some point, it's going to do it. No, what it's doing is making qualified professionals able to leverage their time more, right? So what you're able to do, if you were to throw something in Claude or ChatGPT or anything like that, it's going to be 80% correct, but are you willing to chance that 20? What we're able to do, and where I see kind of the sweet spot, is you've got a trusted advisor who's leveraging those tools to gut check it, to analyze the outputs, to make sure there aren't mistakes there. Regardless, though, the individual that's pulling the strings on that is by far the hardest part, right? It's that's why we tell people, there's a 3-year exit prep. It takes time to hand off your sales responsibilities to somebody else who's leveraging an AI tool for leads. It takes time to manage operations. You could have the best systems in the world. You could be changing 0 systems. It's still going to take somebody time to step in. And if I'm a buyer and, oh, hey, here's the new guy who started last week, you might as well have me insert somebody new. And essentially I'm taking a huge risk at that point. You want to have time in the seat for those individuals, so people still remain the biggest item.
Yeah, no doubt about it. Next piece I want to talk about is the framework and the build out. In this second episode, we're talking a lot about, how do we operationally how do we operationalize the company in a way, and as an advisor, as an RIA, like how can we work with a high point advisory group, like somebody with your background, to sort of create more value at the, in the third episode, we're going to talk about how do we, maximize the value at the point of sale, right? So this middle piece is where if an owner is, say, 5 years out from a potential exit, okay, we'll just use round numbers, and wants to use this runway they have, this 5-year runway, well, what does the build out sequence, when you guys are sitting down with a prospective client? I know it depends. There's a lot of gray in what you guys do, but what does that 5-year roadmap look like? Where do they start, typically?
Yeah, great question. And if you're prepping 5 years in advance, that's phenomenal. The unfortunate reality is a lot of folks say, "Hey, I'm going to sell in 5 years. I'll start prepping in 2 or 3," and then some unimaginable circumstance comes along. You have family health issues. You have a downturn in your industry. There are a number of things you want to be positioned well ahead. So if something happens, you have to sell. A, you're not forced to, right?
Yeah.
If you're solely dependent, you're not forced to because you're out of the seat. And then B, you have the option to continue on. And C, it's a saleable asset at the time, right? So first and foremost, again, shocker from the finance and accounting guy on the call, finance and accounting is going to come first because that's what's going to supply the data for every other decision, right? You want clean financials, you want monthly reporting that you can make confident decisions on without more than an hour or so to compile these numbers. You should be pulling them from one system, or they should be readily available where you need them to make decisions. Second, I'm going to say reduce concentration. You're going to use that data to say, wow, all of my sales are coming in from one rep, and he may be 65, 70 years old, whether that's the owner or not. That's a huge key man risk. Let's try to separate some of that out. Let's bring in a team so that way, if he takes a vacation, or if he retires, or if she decides to take a sabbatical, sales don't fall off a cliff and it impairs your organization. Suppliers, same thing. If you're a manufacturing business and you only got one supplier overseas, I think we've seen what tariffs have done to folks because they weren't able to pivot fast enough, and it's devastating, right? Outside of that, building a team is definitely going to take time, right? So that's probably the next step, is rather than just, hey, we're going to diversify one person, it's building a team to help scale this, right? Everybody looks at it as, wow, I've got to, if I'm making $100,000 a month, to use easy numbers, oh no, if I have to hire a high-powered executives, that's right off the top 20 grand a month in payroll costs. Well, you're also getting a high caliber employee if you do it right, which should be accretive in the long run. It just takes time. You can't hire an executive team of 8 or a management team with layers all at once. It takes time to sequence these things, build it out, and kind of get it put in right. And then lastly, I would say that the last piece that very few companies or I'd say portfolios have from outside of Andres, the part that you guys would touch is really that governance and capital allocation framework.
Yeah.
In a perfect setup, you've got the OpCos distributing cash up to the HoldCo, and it's being reallocated systematically. You're looking at, hey, if here are 3 companies, I'm putting $1 into each of them. What am I expecting in return on each of those dollars? Start looking at these as an investment, right? Why are we continuing to dump money in the legacy business that's killing us? There's these new profitable ventures we should be looking at. At that point, the decision may be, hey, let's sell that and reinvest into the new options we have at that point. You want to start looking at this, I don't want to say like a dashboard because you are operating the businesses, but you want somebody to come in and look at that where you can reallocate systematically, where things aren't just being done on gut feel. That's what I see 99% of the time.
Yeah, no, there's a graphic that you showed us that really hit home. So I imagine myself sitting with an executive, and we're talking about markets, and they always want to talk about investments, and they want to talk about their portfolio, et cetera. And then you say, well, could we shift the conversation and talk a little bit about, the business and how your business is going? And you guys have this 4-part framework, which I love. And you touched on it, but maybe you can and finish and round it out. But this 4-phase roadmap, phase 0 is like, you talked about the OpCo stability, and you said this in episode 1. Like, if we don't have an operating company that's throwing off cash, we don't really have anything to talk about. There has to be something that's generating cash, right? That's number 1. That gives us investments to that gives us cash to make investments. That gives you guys something to be looking at to optimize. Then you get portfolio visibility, and you talked about this also in episode 1. That gives us like a dashboard and analytics around what are the KPIs, what do the financials look like, et cetera. Like imagine as an RIA knowing that, right? You don't have to go in and run the business, but bring in Brad, bring in High Point Advisories group, build that out. And now, okay, once a month, once a quarter, like the RIA is getting that dashboard, getting those analytics and saying, wow, hey, Mr. Client, like awesome quarter. You guys are crushing it. You must have landed a couple new customers or whatever. Then you have this whole thing about capital and decision controls, right? Imagine being able to sit there as an RIA and saying, hey, I see that you're throwing off $3 million of additional cash, like year over year. Like, where are you guys putting that cash? Oh, we're, putting it into the business. Great. Have you thought about, is that the best place to allocate it? Do they even have a capital allocation framework? And then lastly is just this optionality and scale. Like, how do you expand that 3 to 5? I just thought that framework really hit home because it allowed us as advisors to step in and be able to have a much more strategic conversation than just talking about the economy and talking about tariffs and talking about the market. It's like we're talking about the crown jewel of this person's, literally their net worth is their business. Anything you'd love to add, or I don't know if this is a great time to sort of, walk people through, this framework that we're pulling up.
Yeah, absolutely. Apologies for the crude roadmap drawing. I promise our slideware is getting a little bit better as we go on. But no, I think you nailed it. I'm just going to reiterate, each starts with phase 0. There's no role for an RIA. There's no role for our group. There's no role for anything without a cash flow positive company generating positive gains in order to redeploy either into itself, to its employees, or keep going. The phase most people are at is that phase 0, right? They don't have the visibility. So that's the first thing you come into. If we can get them to 2 or 3 before sale, the exit's a lot smoother. And we'll get into that in episode 3, I would say. Really just being able to make those decisions. For instance, you, Mr. RA, you can come in and say, hey, you're spending off $3 million in cash. Should you be reinvesting? Why don't we go acquire some competitors? There are, and if you need help with that, we can absolutely help with that as well. We help source buy-side deals and identify market mapping, potential acquisitions. Anyone who's curious in the multiple arbitrage opportunities here, it is one of the great wealth generating secrets of this time in the world. I mean, it is truly an opportunity with the silver tsunami going on. So just being able to have those conversations and kind of plant the seed, you may be, yes, you're delivering great returns from a liquid portfolio standpoint, but if you can drastically increase that exit value, that gives you a lot more capital to play with on the back end of this as well.
Yeah. And I mean, as an RIA ourselves, like we want to attract, higher net worth clients that have more sophisticated needs. And that's one of the things that we set out in building Endurance X was we wanted to have a platform that could offer a mix of different things, right? Investments through the private markets offerings, the alternatives, which we felt like is a growth aspect of the wealth management business. More and more clients are asking about diversifying strategies, diversifying solutions. But I also know as an owner of that business, and talking with Brian, like that's not enough to attract people to the marketplace. We have to offer other things. And when we met, it was like evident immediately. You're talking a lot of the same language that we're talking as advisors. You're just talking about it through a different lens. You're talking about building out a roadmap to create more value for your customer, your client. We, historically as an advisory community are the ones waiting for phase 3, which is the scales happen, the optionality of what to do next, the liquidity event takes place, and voila, you get a phone call and somebody wants to, give you another $20 million. What you guys do and where we are increasingly partnering is stepping in and saying, Mr. CEO, Miss CEO, can we sit down, introduce our firm, introduce our partners at High Point, and let's lay out what does a roadmap look like for you as the executive effectively running this family office. You've got this operating business, you've got real estate, you've got IP, and I think this graphic, which is something that we can make available, and I know Brad's team can share this. It just spelled it out real clear, and I think for an executive level discussion between an RIA and a client, I think is pretty powerful.
Yep. The other quick thing to jump in on, if you can get to phase 2 and 3, what we're talking about at that point is what is the best return on your capital.
Yeah,
and that's one thing we absolutely want the RIA involved in. I think everyone on this podcast who's tuning into this would agree if you have an advisor that's going to make them more profitable on the exit, but we're also looking at, wait a second, if you spend all this time and money and headache integrating M&A or just continuing to invest in the business, what can we do with that money elsewhere? The other thing we always look at is how much cash is actually kept in the business from a liquidity standpoint. I'm sure we've all got clients who feel really good about the money in the bank account. Looking at it, say, hey, best case scenario, it may be in a money market account inside the company. Why don't we reduce some of that? Give it to your RIA who's generating double-digit returns year over year. That's the smartest thing for you to do with your money. We will send that to you and let you handle that from your your area of expertise, if you will. So that's something. It's not just a one-way referral source. A lot of times we're coming in saying, hey, you've got $3 million in a non-interest-bearing account. Why, right? There are a lot of things we can do with that trapped capital to unlock it. And obviously it would go straight through you guys.
Let's talk a little bit about this family office readiness framework. I know that's that's an area that attracted, us to want to dive in and do this series, as I felt like it's one thing to talk about the buy and the sale, but I think this middle episode is super important. Hopefully people won't just skip straight to 3, right? It's like, let's talk about the exit. Let's talk about the liquidity event. That'll be a big one, big discussion. We'll do that shortly, but let's talk about this readiness checklist. For the RIAs that are listening specifically, I mean, again, this is all about empowering them with tools and resources. If you're an RIA listening and you're saying to yourself, I want to be able to assess where my clients actually stand when it comes to operating and running like a family office, whether you offer family office services or not as an RIA, the ability to sit with a client, some of your more sophisticated, ultra high net worth clients in particular, which I'm sure many of our RIA customers have a few, or at least aspire to have more of them. You want to be having this strategic level discussion and see where there stands. What are the 9? Maybe walk us through those. And then which ones do you think, in your experience, the owners that you've sat with, which ones do they care about?
Yeah, great question. So to give a little bit of background on this, when we have clients come in, they're really in 2 buckets, right? We always start with an assessment. Every single one of them, we're going to deeply analyze the financials. We're going to look at them, how they're operating from a reporting standpoint, soup to nuts accounting. We're going to handle the entire thing there. That's non-negotiable. I don't care if I have to give it away. We're doing that so we understand what we're starting with. More sophisticated clients benefit from this, right? If you're already past phase 0, as this client was, they had the goal setting was top notch, strong EOS client. They knew exactly where they wanted to be in 1, 3, and 5 years. They knew exactly what they wanted to do in the operating company, right? We choose to look at the whole portfolio when we do this, and we're like, great, what about the real estate? And they just kind of looked at us. They were speculatively, it was a home builder. Not to be too specific on location, but custom home builder. They're doing about 20 million in revenue on this one, and there was no goal setting. They would buy a random rental here. Oh, my neighbor had a field, I bought that. Oh, hey, we may develop these one day. That doesn't work. That's not the most way to effectively allocate capital and expand. So that's really what led to this, is us going through, okay, let's assess them if they really want to. I mean, this gentleman in particular said, hey, we're a construction company. I want to buy a fencing company. I want to buy pest control. I want to keep expanding, buy competitors. I want to vertically and horizontally integrate a bit as we expand here. And what it let us do is say, hey, you're not in a place to do that right now, right? Like, you're running a very profitable business, but you're not there yet. So we came up with these 9 dimensions to really score people. We've gone back and forth. Now it's more of a numerical exercise. This was kind of a scale of 1 to 5 type thing. Here it's a fully in place, partially in place, or not in place, right? So going through those, governance and control. It's really, are you meeting as a board? Do you have a regular review cadence that we're handling with an outside party to hold management accountable? Whether or not the owner of the company is on this board, they should be answering questions. And I think we can all find value in being held accountable for what we should be doing, or at least explaining ourselves. On the legal and entity architecture standpoint, there was room to improve there. I would say they kind of had they had a reasonable structure, but there was a lot more they could have done from a tax and liability limiting standpoint. Financial infrastructure, that's what we spent the majority of the call talking about, is, hey, what's the reporting look like? How are we handling that? Capital allocation, investment discipline, they got a 0 on this one. And that's where we see folks saying, oh, my neighbor wants to sell his company, so I'm going to buy that one. That may be a great acquisition, but how would you know? You haven't gone out to market. You haven't tried to strategically source deals. And this is what we see a lot of times doing it.
Well, it was, or there was business was on sale, so we just bought it and tucked it in, but it doesn't maybe have the capital allocation
Exactly.
decision framework applied to it, right? And so, and imagine as you have more cash to deploy, more opportunities suddenly find their way to you,
Mhm.
right? And all of a sudden you look up and you have a closet full of stuff. And is it, is there a framework that's being applied? Is there a discipline that's being applied? I mean, anybody can walk in their garage and probably pull half the stuff out and say, I really don't use it anymore,
Yep.
right? And I'm like that, right? Just got a lot of tools I don't need, right? So the same is with business, right? I mean, you just end up with a lot of assets when you are wealthy and when you have a lot of capital to deploy. You just end up with stuff. And does it
Totally
fit?
agree.
Yeah,
Exactly. I mean, most of these guys can't answer what is your weighted average cost of capital? What return do you need to be
right,
chasing for a break even on this investment? Let alone,
right.
hey, I know if I hand my money to Andres, I know he's going to get X%.
Yeah,
Why would we think about doing anything if it's not substantially higher than that and we're going to take more risk on it? You need to adjust that risk reward. So that really wasn't in place to kind of round these out. So risk management and asset protection, pretty self-explanatory in that one. Human capital and shared services. Do you have shared services you can kind of deploy across? Is it set up properly? What we see a lot is the main OpCo is employing everyone and the services are being robbed elsewhere. Well, if you ever want to transact with any of those other companies, it's going to be a major exercise. You're going to have to pay someone like me to come in and right size it. And it's ultimately not accretive. So you might as well set it up to start with. Tech and data. So what systems and tools are in place? That's a pretty self-explanatory one. And then the strategic optionality and exit readiness. That's where you want to say, hey, here's the data room that we keep stocked quarterly. If someone wants to come make an offer, I think everyone, if they're approached, should listen to the offer. Never say no until you know what it is, but until you have the data ready to go and a sample data room to say, oh, sure, we haven't updated it in 6 months, but here's what it was 6 months ago. We can update that by today's Friday, Wednesday. We can have that done for you if you're curious, right? That's a much more powerful place to be exiting a company than now. So hopefully that gives everybody a little bit of insight and kind of what we walk through
yeah,
and
yeah.
show area for improvement across all of these.
One quick follow-up I'd love to ask you about that's just come up more and more is cyber and cybersecurity, and just how do you help customers when you see areas that are just there's exposure, right? Because that's a real red flag. And when you get into diligence on buying companies or advising on purchase price, I would imagine that this is an issue that's come up. Have you had a cyber incident? Is there strong controls in place? Maybe you could speak just to that for a few seconds.
Yeah, absolutely. I mean, in this day and age, you've got everybody in a family office or organization that's got some type of cell phone, some type of laptop. You've got, I mean, many folks employ individuals overseas with no virtual desktops, that type of thing. So it's always something to look at. I would tell you, trust that to the experts, right? I know that's not a particular area of our expertise, but we do have some strong partners. And Andres, I'm sure across the platform, you also have some to recommend here. But absolutely, that's a huge risk that we look at on every single acquisition.
Yeah, one of the areas I think we can both agree on, and you spent some time on this in the framework, was the institutional discipline around capital allocation. I mean, I think as RIAs and wealth advisors, and many of the people listening would probably say they take great pride in being able to, be objective and help their clients think about a way to have a discipline, to be diversified, to have a structured approach that's nimble and flexible and can take advantage of market opportunities and inefficiencies, et cetera. I mean, that's something that I think a lot of financial professionals are attracted to the wealth management business around. But capital allocation as an owner and capital allocation as a busy family office executive that's got an OpCo and has real estate and has IP and has all this stuff going on, I think sometimes can get sloppy. What I thought would be really good is if we just spent, a second or two talking about what does that discipline look like. You mentioned weighted average cost of capital. What are one or two things we can leave our RIA audience with when it comes to how do we introduce this touchy subject? Because we're not talking about, hey, let's go deploy more capital into, the bond market or to the stock market. Let's talk about, buying businesses, and does it meet like an internal threshold of our cost of capital? Can you speak to that just for a second or two?
Yeah, absolutely. Once you're above the, hey, I have a single operating entity and that's what generates cash and that's what I do with it. At that point, it's basically you've got a couple options to do with your money. When you've got multiple options and you've got a president of each company, you've got your property manager saying, hey, the apartment complex you bought 3 years ago needs a new roof, and the HR and your opcos, hey, we need to hire 10 new people for X, Y, and Z. And, oh, by the way, I haven't been investing like I'd like to. You have a windfall, or, you continue to generate cash. What do you do with it? So perfect world, free cash flow is always going to flow up to the holdco. And it goes into four main, there are other options, but four doors, right? So it's either acquire, reinvest in that OpCo, distribute to the family, which you're going to have to do some of. You got to eat, you've got to pay the bills. We certainly understand that. Or do you want to pay down debt, right? Where do you want to go with that? Within reinvesting, I would say there are a lot of options there into different OpCos. There may be a point at which we say, okay, great, let's get a written framework. Actually, that's probably the next step is get a written framework with return hurdles, approval thresholds. And part of that is give money to the RIA, right? There should not be a scenario where, okay, it's the end of the year, here's, a check. This should be a regular cadence where, hey, I know a portion of this is going to Andres. I know a portion of this is going back into the business to fuel growth. We've got some great opportunities. And then we're going to look for a transaction or two. We're going to acquire a few things. We're going to move on from there.
Yeah.
The cadence needs to be at least quarterly. I know, Andres, you'd probably say faster. I'd say at least quarterly. Things change. The market shifts with interest rates. I know we're seeing that across all asset classes, but in buying companies, if that gets it's a little bit cheaper, probably time to make an acquisition, move forward if you can find some good deals. And I mean, the whole key is having the owner shift from just an operator. Hey, what is the biggest problem in the business, to taking a step back and saying, hey, you know what? Honestly, I'm fine if we're undermanned slightly over here because my return on that dollar is massive on this opportunity. So you're starting to look at it more, again, as an investor in your own portfolio than just an operator.
Yeah. No question. I mean, it's really fun sitting here talking with you about this stuff because it allows you as an advisor to really take your, if you're a CFP or you're a CFA or somebody that really just, gets excited about diving into the markets. And there's some big IPOs that are, coming, to the table with SpaceX and Anthropic and others here in the coming weeks. So there's a lot of excitement and probably a lot of questions. But there's also the day-to-day of your clients' lives, and 70, 80% or more of their net worth is likely tied up in that business, in those operating businesses. And so I think what we're both trying to say is have a regular cadence, get much more integrated into that conversation. And a great way to do that, like for us, has been just building the relationship with you guys, because this is the language you guys speak. These are the services you offer. And we look like a superstar when we bring, you guys to the table. And it's just that simple, right? We will ultimately have a client that's much more organized. We'll have a client that's got a business that we have more visibility around. We'll have a client that's got a business that's growing in value, and we'll have a client where we have a much, much higher probability of, when there's a transition or when there's a liquidity event, of having more assets and not less assets, to go and deploy. And I think that's something that most RIAs, on the call, would say they want, right? They want to grow their book of business. Can you talk about why the operational, setup, and why getting it right? Like maybe there's an example you can give in terms of exit value, which we're going to, we've got a few more minutes, but teasing out what we're going to talk about in episode 3, which is the exit. Can you give, like, in real dollars, like some of the, maybe there's a bad story out there or unfortunate story out there when somebody said, man, I thought I had this all set up to go and get X, and I was going to be able to, go retire to the mountains or to the lake or the beach. And then you go through the process and it's like, sorry, you're going to get half or less than half of what you anticipated. Is there an example you could share?
Yeah, so we're in a unique spot on this one. It's a great question. Typically, our clients are in a better spot because we preach this, and frankly, we don't really keep clients. They don't like listening to us. I don't say lecture, but insist on, hey, you've got to instill the discipline. You've got to go forward from here. If they're not interested in doing that, we're not the right fit for them as a financial advisor in any capacity. So I would say ours don't experience this a lot of times. That said, we do buy and sell side diligence reports, right? We do quality of earnings, we do the whole 9 yards. And I mean, I can't tell you how many times, both on the sell or buy side, we're getting in too late. That's zero operating prep. We see companies where we come in and we run a proof of cash and we literally have no comments. And then we say, okay, we need to do more analysis just to provide value and earn our fee so the client feels acceptable. But we know this business is airtight. There's no comment on that one, right? On the other side, I've seen them that just absolutely implode at the closing table. You know, for instance, we're doing one, we've done one recently. It was about a $15 million transaction, construction business. And I'll give you two construction examples because they're notoriously bad because of all the accounting upkeep, WIP schedules, job costing, and the like. One had a $15 million offer with a $5 million seller note, $10 million cash at close. We get down to the finish line. They've got no inventory system. They've got nothing to tie to. There's no way to track COGS. We literally can't do anything to write a sell side QE and save this thing. That one's going to transact at a fraction of the cash value. Now, if it transacts at all, this guy's got a couple options. One, it can either go back to the drawing board and say, hey, we're going to hire you guys. We're going to implement all these things. We're going to run it for 2 years. And then we're going to exit. Probably worth the money, in my opinion, for what he's going to get in cash. Alternatively, he can close, but it's likely an earnout, a seller note, and a little bit of cash from a family office. Guys, everybody on this call, if you hear one thing today, the seller note is not guaranteed on this. If the business doesn't perform, you're trusting the business to somebody else. Sometimes it's the only way to bridge the gap in these scenarios. You're not guaranteed that money. So the cash value at the table went down from guaranteed 10 to 3, and we'll likely never see that 15 unless a freaking miracle happens running through this. Another one I've seen recently was one down in Miami. They actually did not work with us. It was about a 5 million EBITDA, 30 million revenue construction company. This is kind of a funny one. They literally had nothing but handwritten invoices, orders, change orders, period. And they were very confused why they'd been in and out of LOI with private equity 4 times in the first 6 months they'd been on the market. Well, the guy it would have cost about $150,000 to go in and recreate the financials so someone could actually pull the detail out of it. They wouldn't even pay that. Yes, nobody likes paying for accounting and financial services in that aspect, but you're stepping over dollars just to save pennies at that point. And they're never going to transact if they can't get something reasonable.
Yeah, and we've all heard about those clients that we were going to close 3 times. We were under LOI and it didn't. And now we're hearing the reasons why oftentimes. Wrapping up episode 2, we've talked a lot about operations. To finish up, let's talk about the advisor's role in this, and make sure that the advisors that are listening, because again, we're doing this to hopefully empower RIAs. Yes, we want you to work with us at Endurance X. We want you to look at the investment opportunities. We think we have some really great ones, but more importantly, we want you to be empowered with more tools and more resources and more from our platform partners like Brad and High Point Advisory Group to go out and win more business and to attract more clients and to serve your current clients in a deeper, more strategic way. So let's talk about the advisor's role. Here's the question I think every RIA listening is sitting there asking themselves. This is not wealth management. I'm a wealth manager. Like, my job is a wealth manager. And what is my role during these operating years? I know that I need to be there 6-12 months before the sale, maybe during the sale, with the M&A people, with the lawyers, with the tax people, understanding, guiding my clients, sitting next to my client. But it sounds like you're asking me to be there like quarterly, or having these conversations about their operating business quarterly. Where does this partnership come in if I'm the RIA and I'm listening to this?
Yeah, it's a great question. And listen, I think flooding the zone is a great way to say this, right? When I need somebody we had one of these recently where they said, hey, I need somebody to evaluate alternative assets for me. I said, I know the guy. I've got it. There's one.
And we appreciated that intro.
It was right there. I'm like, awesome. That makes me look great. And I don't have to pretend to be something like that. I'm not asking you to come in and do a 13-week cash flow forecast and start operationally managing receivables and payables to stretch working capital and figure out how these things work. What I'm asking is you to ask the question because you're there for your client. You can quarterback the relationship. We will come in and do an evaluation. Depending on what they're looking for, typically it runs in the we charge as much as 30 grand for it. Right now, we're offering free evaluations on all companies. Now, if you want the full back caddy family office thing, there's a little bit of cost there just to cover basis. But typically, it's either free or a very low charge to analyze it. And if they enter into a long-term relationship, it's immediately credited back. We will come in, inspect the company. We will work through everything from an OpCo, entity structure. We'll make recommendations. Typically, we issue a value creation plan, and I think our smallest ROI is about 300% or so of the things we found. It is a very small cost and a very large gain, and we can at least detail the roadmap to show you guys where you need to go.
Wow, that's amazing. Okay, last one for this episode. Episode 3 will be coming out real soon. We're going to talk about exit, but I know you got to hop and I got to hop. But for the RIA who's got a client, they're 3 years out from an exit. They've said that to the RIA, and the operating infrastructure is just not there. The RIA knows it, and they're listening to this. What's the first move they need to make this week? Who do they need to call?
Yeah, hopefully we can get my information in the show notes here. Reach out to me directly. I'm happy to jump on a call. I'm happy to walk through it. Again, we're here to help clients and provide value. I'm a big believer in value first. So if you need somebody to have that conversation with you individually first or with your client, which at some point we'll get there, please just reach out directly to us online or via email.
Awesome. Brad Gunter, founder and CEO of High Point Advisory Group. Thank you for joining me on ATL Alts for this second episode to talk about the operating of the business. Episode 3 will be coming out soon, where we're going to talk about the exit plan. We'll leave it there for today, Brad. Enjoy the rest of your afternoon, and we will talk soon.
Awesome. Thanks.
Thank you.